Okay, so now we're going to talk about the initial public offering. So, as I'm sure you know, or maybe you don't know, there are public companies out there and there are private companies. And any company that wants to trade their shares on a secondary exchange to the public has to go through the process known as an initial public offering. This is when a company is looking to raise capital through the public offering of shares of that company. And at that point, an underwriter works with the company to set the IPO price based on the perceived interest. So if this is a hot company and they're doing really big things and they expect a lot of interest in that stock, you may see a higher IPO price. And if it's maybe not such an interesting company, they may have a lower IPO price. But this is something the underwriter helps them determine the IPO price. Now what happens is the institutional investors, which are the large investors with millions of dollars to invest, they are given the opportunity to purchase shares at the IPO price. Now you as a small-time investor, you are likely never going to see that stock at the IPO price because by the time it trades on the secondary market, the market has already set the price for that stock and it's going to be much higher typically than that IPO price. So after the large investors are given the opportunity, the stock trades on the secondary market. And depending on the level of interest, the stock may trade significantly higher on the secondary market. And obviously in the last couple of years in this bull market we've been seeing, many stocks that have gone public trade significantly higher on the secondary market than that initial public offering price. So as a small investor, it is difficult if not impossible to get in on the initial offering. IPOs are also a high-risk territory, and I don't recommend you guys invest in an IPO. So here's the biggest problem I see with IPOs. People think it's great because it's a new stock they can invest in. They want to get in on the ground floor, and they say, okay, a stock is going public. I want to, buy up some shares. Look at what happened with Snapchat, guys. The only reason you should invest in the company is if you really like that company and you want to be a part owner of it. You don't want to invest in the company solely because of the fact that they are going public. Drastic price fluctuations are usually seen as the market sets the price for the stock. So it's a very volatile time for this stock. It's high risk territory. And as we've seen with many IPOs recently, I mean, look at the Blue Apron IPO, the Snapchat IPO. If you go back and look at the Twitter IPO, look at the GoPro IPO, all of these stocks fell significantly after their public offering. So all of that hype kind of died off, and then, they were set at an accurate market price, which was much lower than that stock was trading at. So most investors should avoid investing in a stock for a few months after the initial public offering. If you're looking to make a long-term investment, guys, wait for the market to set the price, and odds are most times you will see a stock price come down after that initial public offering. It even happened with Facebook. I know they really took off after their IPO, but if you look at the stock price, which I believe I have that coming up here, during the initial public offering, they did come down off of the what they first traded at on the secondary market. So unless you can get in early, unless you're an institutional investor, or for whatever reason you're able to get in on the first round at the IPO price, you want to wait for the price to settle and for the excitement of that initial public offering to drop off. So first example here is Facebook. So this is a stock that had a fantastic IPO. As you can see, they started trading on the secondary market around the $40 range. I'm not sure what that price was. But even that stock in the first couple of months there, as you can see, it fell from that IPO price. But obviously now, a couple of years later, this stock is at $171 a share. And this was as of August 7th. So I'm not sure what that stock price is at now, but obviously since their IPO at a $38 initial public offering, this has been a wonderful IPO, and unfortunately I think a lot of people are trying to buy the next Facebook, and that's why a lot of people invested in Twitter and Snapchat, because they're hoping for it to do what this Facebook IPO did. So now let's look at an IPO that didn't do so well. Here's the Twitter IPO. So Twitter went public at $26 a share. When it hit the secondary market, it was well over $40 a share, so there was a lot of excitement surrounding that stock. It broke $60 a share. I believe they came just close to $70 a share at their peak, and then they went into a downtrend here as the excitement tapered off, and here they were on August 7th at $16.38 a share. That's way down from that IPO price, and much further down from that $70 share price back in 2014 when it peaked on the secondary market. So this just goes to show you guys how an initial public offering can be high-risk territory. You certainly see more cases like Twitter than you do see cases like Facebook. So I just want you guys to understand that, not every IPO is going to be like Facebook's IPO.